Hello and welcome to Reboot. I'm Rebekah Campbell from Zambesi.com and I will be hosting today. So before we start, I just want to start by acknowledging the Gadigal people, the traditional owners of the land in which much of us are meeting on today, and their elders past and present. And because we're online and people are joining us from all sorts of different locations, I want to acknowledge the traditional owners of the lands in which everybody is meeting in today and any Aboriginal Torres Strait Islanders participating in this meeting. So if you are new to Reboot, if this is your first time at one of these sessions. So this is part of a series that's been put together by the City of Sydney and Zambesi to support businesses to recover from the impact of COVID and to bounce back better and bigger in 2021.
Thank you, Rebekah, and hello everyone. Welcome to our Reboot seminars for 2021. I'd like to begin by acknowledging the Gadigal people of the Eora Nation, the traditional custodians of our land, part of the oldest living culture on earth, and I pay my respects to their elders. I also acknowledge the people of the many nations who live in our city. And I'd also like to welcome the many local experts participating in the Reboot series and sharing their knowledge with our small businesses and startup community. Last year, at the height of the pandemic, the city surveyed our business community to learn what you need to survive and to recover from the damage brought about by COVID. In response to what you told us, we launched the Reboots webinars to equip you with the skills and strategies that will help you thrive in these challenging times. The first series was delivered between October and November last year, with more than 2,800 businesses registered. And I am sure that you will benefit equally from this new series. So thank you for your interest in attending today. And I'll leave you with Rebekah and our local experts to advise you on how to strategize and plan for growth in this ever-changing economic environment.
So we're going to share and chat a link to our past events. So we've now run, this is our 9th, and there's a whole bunch of great events there. We ran digital marketing with Tim from Koala and Pilot. We ran content marketing with Chris, the founder of Pedestrian. Last week we ran a great event with Ben, who's the co-founder CEO of Employment Hero on Operating for Growth. So if you like this event today, please check out the other ones using that link on the City of Sydney website. So today we are talking capital raising in 2021 with Rick Baker from Blackbird and also Kylie Fraser from Eleanor VC. We're going to learn how to approach investors, what investors are looking for at the moment, and how investors can support your business after they have invested. So to start with, we're going to start with short presentations from Kylie and Rick. Then we've lined up 8 founders who have questions that they want to put to Kylie and Rick. So we'll have rapid fire questions and we'll then have questions from you. So if you hear something during the presentations or during any of the questions from the other founders and you have a question yourself, please use the Q&A function, and also please upvote the questions that you want to hear in case we can't get to all of them. So I'm now going to start by introducing Kylie Fraser, the first of our investors, who's going to give us a presentation on how to approach investors and how to get investment, sorry. So Kylie is the founder of Eleanor VC, which is a fairly new early stage venture capital firm. They have already invested in more than a dozen startups, including Fresh Equities and GoTerra. So Kylie has been a founder herself, and she's passionate about encouraging others to enjoy the joys of early stage investing. So over to you, Kylie.
Thanks, Beck, and I'm delighted to be here today. Let me share my screen so I can show you some slides that we've done. So Eleanor is a new venture firm. We operated as a private syndicate for a little while before becoming a more full-service offering firm. We've got 21 portfolio companies in there now, so I think the intro that I provided, Beck, might have been a little bit out of date. And we make it easy for early-stage investors to build their own diversified tech portfolios. We invest in a range of technologies, a lot of B2B SaaS, a lot of kind of standard software companies, and also some more esoteric things. Ag tech is a particular passion of mine personally. I think Australia's got some great comparative advantages to exploit in ag tech. So we've got an emerging kind of investment thesis around that area, which has been really exciting. We are a partner-led firm, so there are 3 partners, but 2 general partners, myself and Rachel Newman. Somewhat confusingly, we operate under 2 brands, or we have until recently. We're in the process of a rebrand to bring Eleanor Venture and Working Theory Angels together as one entity. But if you're reaching out to, if you're a founder who's looking for an investment and you're reaching out to either Rachel at Working Theory or myself at Eleanor, rest assured that they are well and truly one entity. You don't need to hit us up. An investment by one will mean that you get the support of both of us. How to find us. Rebekah asked me to give some tips today on how you go about finding your early stage investor. And first and foremost, for us at Eleanor, there's a link on our website that you can fill in. It will prompt you to answer a few questions, and we regularly screen that. So that's a really good way to find us personally. But if you spend any time at all on the internet looking at how you should approach an early stage investor, you will find a lot written about hot, warm introductions. I'm looking at this kind of like slide. It's very hot and cold rather than warm and cool. But the art of the warm introduction means finding someone who can introduce you to us. Lots has been written about the need for warm introductions, making it harder for people from diverse backgrounds to connect with the venture community. And for that reason, nearly every venture firm in Australia now will allow you to approach directly. You don't have to have a warm introduction. You can come into our website. Everyone makes their email addresses public. You can just reach out. However, if you can find a warm introduction, it usually means that you'll get put to the top of the heap. Every investor receives so much deal flow. You know, we're reviewing probably 30 to 50 decks a week. And the reality is that we just can't get through all of those in as much detail as every single one deserves. So we read the ones that come from trusted sources more quickly and more closely. So to give yourself the best chance of being paid attention to, it really is in your best interest to try and find a warm intro. And the good news is that LinkedIn makes it very easy. We all list our portfolio companies. There is nothing an investor likes doing more than bragging about the investments that they've made. So you can see all our portfolio companies on our website. Actually, our website's not up to date, but bear with me, it's coming. Most investors have up-to-date portfolio pages on their websites, and you can, the best way to find that warm intro is through one of our existing portfolio companies, because we already love them and we place a lot of value in their thoughts and opinions. So if you can connect to someone through LinkedIn who's known to one of the portfolio companies, that's absolutely grade one. But any kind of warmth that you can add to that introduction will help cutting through the noise. It's not essential, but it helps. Regardless of how you're reaching out, we always like to see a deck or at least enough information to be able to understand what the investment opportunity is that you're putting forward to us. I know a lot of investors have, and I'm probably one of them too, have a pet peeve when someone sends you an email or a note on LinkedIn saying, hey, I've got a great deal, can we set aside half an hour and I can tell you about it? It's like, you've got my attention now. Tell me what the great deal is. I'm not going to go back and forth and schedule a time so you can tell me about your great idea. So make sure you can explain it succinctly. And the best way to do that is in an investor pitch deck. There are many templates out on how you can put a investor pitch deck together. Innovation Bay has done a great series on unbundling the investor pitch deck and going through in detail what you should include on each of those slides. And I can pop that link in the notes in a sec. What should you put in the deck? Remember, the the aim of the deck is to get a meeting. You don't need to put absolutely everything about your company into that deck, but you want to put enough that gets me really excited so that I can't wait to reach out and schedule that meeting with you. I want to see that you're obsessed with your customers. All founders are obsessed with their problems, and that's a great place to start. But I want to know that you are obsessed with your customer and that there are other people who are obsessed about this problem and willing to pay for it to be solved. Second thing is describing what your unfair advantage is. What's your special sauce? Why are you going to win? Startups are hard, and we want to invest in ones where we know that there is some unique proposition that's going to make it easy for you. That may be your experience or your background, your networks. There's many ways that can be explained. And the third one is sometimes the hardest, but I think it's the most important, and that's why now. Startups fail most of the time for timing considerations. They're either too early or too late, and timing is the hardest thing to get right. In some ways, it's synonymous with luck. But what we're looking for as investors is that you understand the importance of timing to your market launch. So if you look at a company like Uber, Uber became so successful because the developments in GPS technology and low data rates on mobile comms made it easy for them to get started and gain market share quite quickly. We've invested in a company called Jigspace, which does learning tools for augmented reality. So it's like learning in 3D. It's not, 3D learning isn't a everyday consumable yet, like GPS is on Uber, but we believe that AR and 3D learning is going to become more important in the future. So the time to invest in a company like Jigspace is now for us. So really understanding the importance of timing to your investor pitch is super important. And then what don't you want to do? These are always fun. The negative screens are the best. That first one, failing to explain your product. It sounds so simple, but I can't tell you how many decks I get where it's like, I just can't tell what it is, and we do this for a living. We're good at understanding what things are. If you can't explain it to us simply, that's not a good sign. We're not obviously going to get across all the nuance, but we don't need to, and it's your job to make sure that we can understand it, at a very bare bones level. The second one, if you are successful in getting a meeting, congratulations, you made a pretty deck, then it's never a pitch. I think founders are sometimes confused when they come ready to their meeting and they want to take me through a deck and, go through some charts and have a very one-way conversation. It's not a presentation, it's a conversation. So you need to be ready for some pretty hard Q&A. Investors will have been over your deck with a fine-tooth comb and will want to have discussions about the weaknesses in it. So it can be disconcerting for founders if they're not ready for a conversation, if they think it's going to be a shiny pitch. It never is. And the third one is about respecting your competition. I hate decks that say, we are the only one in our category. There's no competition. There's always competition. There are very few breakout category creations in tech. And so maybe there's not another technology company in your space, but, so explain what the status quo is. Is it pen and paper? Is it Excel? There's always something that should be, kind of explained to help us understand why your technology is so disruptive. Once you've had your meeting, what happens next? And I like to refer to it as kind of reading the VC tea leaves, because it's not as straightforward as you might think. Investors are spectacularly good at saying no. We say no all the time, and sometimes we say no in such a polite way that founders think that we're actually saying yes. And that can be problematic for the founders who who get more excited than they should based on how some investors message that no. We always want to preserve relationships, right? You know, just because this isn't a great match for investment with that particular investor at this point in time doesn't mean that that's the end of the relationship. You know, maybe that investor will want to come in a later round. Maybe that investor really likes you, but they just weren't convinced about this idea and they want to have a relationship with you if you start another company. There's so many reasons why we want to keep those relationships professional and courteous and positive. But sometimes, you know, the truth of the matter is that if an investor really wants to invest in you now, you will know, because it will get hot and things will happen very, very quickly. And anything other than that is more than likely a very polite, very respectful, not just yet for us, sorry. And that's all I wanted to cover today. So I'm going to sign off and leave you in Rick's capable hands.
Awesome. Thanks so much, Kylie. I am now going to hand to Rick. So Rick is going to talk about what happens after the investment, although I know there is a lot of questions for Rick from the other founders that will be joining us in a moment about how to reach Blackbird and what they look for in a pitch as well. And thank you, Kylie. That was a really useful overview. So I want to introduce Rick. So Rick is one of the founding partners of Blackbird. He has also co-founded 2 very successful software companies. And when I first met Rick, he was at MLC running a $500 million fund for them. Now he looks much funkier, as you will see in a moment, than he did when he was wearing his suit at MLC. At Blackbird, he has led a lot of very successful investments. He's particularly well known for being very early, I think, possibly the first investor in Safety Culture and also in Canva, which are now both billion-dollar companies or billion-dollar-plus companies. I'll hand to Rick, who will talk about what happens after the investment.
Great. Thank you, Rebecca, and great to be here. Fantastic. So look, great to be here today, and firstly a little bit about Blackbird. We're a venture capital firm based in Sydney, Melbourne and Auckland, New Zealand as well, and I'm based in Sydney. We invest across a broad range of technology, from software and internet through to the crazy stuff like space and robots and autonomous vehicles and all sorts of things like alternative protein. So a really broad range of investments. And we also invest across a very broad range of stage. So we will invest super early when it's just an idea, and we'll invest small amounts at that stage. And we'll hopefully, in the best companies, follow them all the way through their lives, through to investing much larger sums of money as the businesses grow and need that sort of capital. So today I'm going to talk about working with VCs, what to expect after the investment. So you've just gone through the process that Kylie explained, and you've been successful, and you've negotiated the final shareholder and investment documentation, and you've received the capital in the bank account, and kind of what happens next. And one of the things that VC promises is much more than just money. It's this idea that along with the money comes a whole lot of help from the VCs. And I want to start by just being a little sort of cynical, because we all promise to be superstars and superheroes. And we promise to be this kind of font of knowledge. We promise to provide often silver bullets that means you'll be successful no matter what once you've taken venture capital money. But I want to be kind of, absolutely sort of a realist and say, in many cases, we don't live up to that, and it can be much more of a business relationship than you would want. And I think there are sort of two learnings to come out of this. One is that as VCs, we really need to strive to work well with founders and really add value. And then as founders also, that you really need to put a lot of effort into the relationship that you have with your investors, not just venture capitalists, but angels as well. And also that we can't expect it to just be this silver bullet. It is something that needs a lot of work, but that can be really fruitful in the long term when it clicks. So how do we strive for this sort of superhero status? So here are a bunch of things that many VCs do that we focus on at Blackbird. The first one is founder support. The second is this idea of founders helping founders, very central to what we do at Blackbird. And the third is a program that we've put together to help increase the chance of success, help founders learn and level up through their journey as founders. So a little bit more detail on that, starting with the founder support. This is really a one-on-one relationship, and it can be a really, really awesome relationship when it works. Really the partner being this sounding board. I think a lot more, less of an advisor and more of a sounding board. Someone to share ideas with, bounce ideas back and forth. It should always be that the founder knows the most about their business. And so this is really a sort of a testing and challenging kind of relationship. It's very often a shoulder to cry on when things aren't going that well. And one of the things that venture capitalists can bring to a business is this sort of taking a bit of the emotion out of the roller coaster of a startup, because we see so many businesses and we see things going wrong so often, and we see the mess of startups, that we can actually help and be a kind of a rational voice when things aren't going quite so well. Obviously, we can join the board and we can be a board member, and that has important governance functions around it. And we can be a connector, someone who has networks and can connect you to the right people. But most importantly, I think when the relationships work the best, you become a friend with this person. And if I think of some of the the proudest things that I've I guess done during my almost 10 years at Blackbird now is the friendships that I've built up with founders and that relationship. The second thing we do at Blackbird is really focus on this idea of founders helping founders. We're big believers that you get the very best advice from those people who are one step ahead of you on the founding journey, because they've raised money really recently, or they've solved a problem of going from 3 employees to 20 employees, or they've just hired their first salesperson. And you can really tap into that current advice. So at Blackbird, we have a portfolio of 74 companies, and that's about 140 founders. We also have, as investors in our funds, about 120 people, many of whom are tech founders. And this means we've got this community which we just love, and we love really helping founders get together within that community. And you can see a list of some of the things we do here, from introductions. We have this kind of mentor program called Pairs, where we pair people up and we hope that serendipity happens. We run dinners, we run the founder retreat. We have a very active email group where people can fire questions to the community and you usually get great answers. And we run tactical roundtables, so a particular topic, if it's trending or particularly relevant at the moment, we'll pick that and we'll get an expert in to talk about it. And again, most importantly, hopefully you'll make a few new friends. We have this wonderful, communities building in different cities and cross cities where founders get together, apart from us, and we love to kind of see that. That's kind of the ultimate success factor here is founders getting together. Next, we have a sort of a structured series of materials which we provide our founders, starting with an onboarding series, which is all about how to kind of get the best out of the relationship and try and get that relationship going really well. We have a founder academy, which is something new, where we run a series of events and talks with various people to try and around specific topics that all founders have. And it might be hiring team, building culture, how to set up an ESOP, how to do your next round of fundraising, how to prepare for it, all sorts of stuff like that. And then we have a general library. And all of this is absolutely up to the founder, and they can dip in and out of it when they want. But we're building this kind of resource of materials that hopefully can be really helpful in solving problems. And then we do this wider community stuff, which we'd love everyone here on the call to get involved with. We run a conference every year called the Sunrise, which is all about getting great founders to come and tell their stories and talk about the things that really shaped their founder journeys. We run a weekly webinar event called Giants, We have a great podcast, which is again about founders telling their story, called Wild Hearts. We have a blog. A shout out to Tip, who's one of our team members over in New Zealand and has a really great series on TikTok. Tip_NZ is well worth a look. And then we also run an accelerator program called StartMate, which takes companies really early on and runs a whole load of other types of events. So quickly, what do we hope for from founders? Firstly, transparency, so important, and it's really it's more about the bad than the good. People have to really try to tell us all the bad stuff. To listen but filter advice. I think this is really important. As founders, you get often bombarded with advice, and it's actually a real skill set to learn to filter that advice and learn to try and create decisions based on that advice, but not just sort of blindly following one thing. And you'll get diametrically different, advice from different people. Think about culture. I think that's really important early on. I wanted to mention that. It's far too often that founders don't think about the culture in their team and how that pervades. And then finally, be ambitious. We're all about really big businesses, and we want founders to be super ambitious and constantly testing themselves as to whether they can be more ambitious. A little bit repetitive here, but how to get the most out of a VC relationship. Frequent communication, I think, is really important. So we run monthly scheduled catch-ups and then have these much more frequent ad hoc conversations, often over WhatsApp or something similar, where we can bounce little snippets of information or ideas or questions. Talked about sharing the good and the bad. Perhaps just one note there is often with investors, there's a tendency to just share the good and not share the bad because you're worried about maybe getting investment from them later. However, the best relationships really do share that bad news. We really do want to be the first person that you call when something's not going so well. Being specific and then asking to be introduced to people, particularly people who might know more than the people in your current group, is also super important. That's it from me, so I will hand over. Thank you.
Awesome. Thank you so much, Rick. And I also wanted to point out that Rick contributes a lot to the Blackbird blog, and we have shared a link to that in the chat. So I'm constantly finding myself flicking links of articles that you've written there, Rick, to other founders. So I would recommend that you check those out. Thank you. We are now going to come to questions from founders. I've see a lot of people asking questions on the Q&A, which is awesome. Please keep the questions coming and upvote the ones that you want to make sure that we get to. We have 8 founders lined up to do rapid fire questions to Rick and Kylie. I've asked them to introduce themselves and their business in one line, and then ask their question. And we're also going to be sharing links to any of the businesses if you would like to check them out any further as well. So first up, Dennis from Enjoyable. Do you want to introduce yourself and your question, which is going to Rick?
Hi everyone, Dennis from Enjoyable. I'm trying to resolve the issue with late payments and encourage customers to pay invoices earlier. And my question is, what is it you look for in an early stage business that would lead you to invest? Can you give some kind of examples of investment you've made and tell us why you choose to invest in these companies?
Yeah, sure. So firstly, I think late payments is a really big problem and something that there are some really interesting solutions to. So, interested to hear more at some point. So look, what do we look for? I'm a little bit repeating what Kylie said, but starting with the founder, it is so much about the founder, particularly in the very early stages. And we have a few sort of sayings that we use at Blackbird. One of them is a life's work. We're really looking for founders who are obsessed with the problem, and I think that's exactly what Kylie said. Have these insights to the problem they're trying to solve. And then also I think is really important is that they have this ability to pull people around them. And that's both the team, it's potential customers, it's even just people in the community who want to talk about the particular problem. Often we find a really good indicator of a founder who's going to be strong is that they might be they run a meetup or they're the head of the local community in this particular problem. And because this is not a solo sport, it's all about the people that you can bring around you to help solve the problem. For us, it's really important that businesses are global. That's something at Blackbird that we particularly focus on, but there are many other investors who are very happy to invest regionally as well. Look, lots of examples. Look, I'm going to use Canva quite a lot, but when I first met Melanie and Cliff, it was really, really clear that they had a new, insightful take on graphic design. They had this great way of articulating the fact that graphic design was a business that was either done by professionals using the Adobe suite of software, or done by ordinary people using Microsoft Word and PowerPoint, and with usually awful results. And what they wanted to do was produce something in the middle that let ordinary people do beautiful graphic design. And it was just so clear, that mission. And then their ability to then talk about in detail, take that mission and really go down into detail about what it meant to them, was something that really attracted us to them.
Awesome. Thanks, Rick. I'm going to introduce Zach from Mobius, who's got a question for Kylie.
Hi, Kylie. I'm building Mobius, which is a AI-powered patient tracking and engagement platform built specifically for radiologists. And the question that I have is around how much traction do you like to see before being ready to invest? And to give you some specific context, we've built an MVP. We've got a couple of months worth of patient data from a live environment, but obviously the next step is moving towards a paid pilot with real world clients who will actually give us money for what we do. And so just a question around, how much traction would you like to see before you invest?
Yeah, it's a good question and one we get a lot. There's many different ways to measure traction, and you mentioned a couple of ones there that is specific to your business. Revenue is just one indicator of traction. So I don't think, there are plenty of investors, including Eleanor, and I know including Blackbird, who will invest pre-revenue. What we get really excited about is momentum. And revenue is an easy way to measure momentum. If you don't have revenue, how can you show that interest, excitement, whatever it is increasing, and this is the next thing that we really want to get on. So, finding another way to show momentum can get you around the lack of revenue.
Awesome. Thanks, Kylie. Next up, we have Greg, who has a question for Rick around pitching.
I am Greg Denton. I am building Matchstick. We are trying to humanize the career pathways into technology. Rick, my question for you is, how different do you want people to be in the pitching process? Obviously, there's the table stakes information that you want, but if everyone's copying the same formulas, much like CVs, they might all start looking the same and get a bit boring. So do you have any examples of people that have struck a nice balance between the two?
Yeah, so I often say there is a really standard format of the pitch. It's problem, solution, traction, team, use of capital, that sort of stuff. We read about it everywhere. We see so many pitches. And I would say, if following that, you can get a great pitch across. You really can. And by following it, you make sure you hit the key things that we're all looking for. But the very best pitches break the rules, right? And look, still one of the very best pitches we've ever seen was a company called Zoox, which is a driverless car team. Their mission was to build the software, the AI that would drive the car by itself, as well as the vehicle itself. And when it was first pitched to us, this was a brand new thing. It was only really Google working on it. And Tim Kempley-Clay, who was an Aussie, pitched us this most amazing vision of Zoox, this vehicle, and told us this story about how the world would look with Zooxes running around, as a robotaxi, and what the customer experience would be when they hailed and got in a Zoox. And the pitch was built around that customer experience and that worldview. And that was really awesome. And we didn't obviously go through the problem solution team. He had no team, he had no product. It was this very pure pitch of how the world would look like it. So being different is, can be the thing that grabs attention, but it's also dangerous because you can also miss out on all the things that we really want to know about. So perhaps, what's the right, I don't have the perfect answer for you of what to do, but to perhaps make sure you're covering off the key areas, but having a very sort of bold mission statement, and then thinking about how you sort of articulate that vision statement the best, and whether that is through the standard way or whether there's another way that you can take that.
Great, thanks, Rick.
Awesome. Thanks, Greg. Thanks, Rick. We have a question from Anne. This question is directed to Kylie, but Rick, feel free to jump in as well.
So, hi, I'm a co-founder of One Question, along with my husband, Isaac. We help kids learn by delivering a study question before their favourite apps like TikTok, YouTube, Fortnite are allowed to launch. And our question is, how do today's VCs view companies who have or will embark on an equity crowd raise?
That's a very timely question, isn't it? I think there was real concern when equity crowdfunding first came to Australia that other investors would be a bit snooty about it, that we wouldn't like it. I think equity crowd raising has really proved its place in the Australian funding ecosystem. There are a certain kind of company that it just works spectacularly for, and they are consumer facing products. If you are looking to reach a large number of consumers and they are the same kinds of people who you might target in an equity crowdfunding campaign, then that's a great way to kind of kill two birds with one stone. I think it's hard to do them both at the same time. I'm not aware of any examples of doing an equity crowdfund and a venture round at the same time, but there is absolutely no reason why, for the right company, you couldn't start with an equity crowdfund and then move on to different forms of capital, including venture.
Okay. Thank you.
And I'd just say the other where I've seen it used a couple of times is when there is a venture investor who's, say, half the round and you want to fill out the rest. It's actually been a really nice way to fill out rounds as well.
Great. Thanks, guys.
Thanks, Anne. Thanks, Rick. So next up we have Vinesh, who has a question specifically around B2B and enterprise businesses. The question is to Rick.
Hi, Rick. I'm the founder of Autonomy. So we are building branded assets, which are for regulatory environments, automating the entire set. What I wanted to query is, we're working with enterprise at an early stage. What kind of traction do you want to see? I know this question's been asked, but what kind of things do you want to see when we are talking with clients like Bayer Global, Novartis, Unilever, and the time frame for those conversations is quite long. The normal revenue speak cannot actually come in play.
Yeah. So look, it is absolutely fine for us, and I think Kylie as well, as we said, to invest pre-revenue. And in fact, we will even invest pre-product if we really love the product. The hurdle rate is always harder to convince us if you don't have a product yet, but if you can, then we will invest. So coming down to SaaS, look, from our point of view, what we're really looking for is a product that actually changes the way people work. So it's not just sort of helping them do their job 10% better. It's something that will become embedded in the way they work and actually change to some extent the way they work. And a good example of that is safety culture. So that is all about safety management. And it really changed the way that organizations think of safety from a top-down model to a bottom-up model. And the beauty of safety culture is that it empowers the individuals who are actually the beneficiaries of this safety to actually do something about it and get involved, and then push that information back up through the organization. And so we loved that when we saw it. The other thing I think that's quite important, at least to us, is innovation around the sales model. And you talked about a long sales cycle to big organizations. That is not the end of the world, and we will invest in companies that have longer more people-intensive sales cycles, so enterprise sales. But we're really, really looking for sales cycles that are light and fast and efficient, and particularly love bottom-up sales. And that's not applicable in every case, but it's actually amazing to think that bottom-up sales is working very nicely now in applications that people would say to me before, oh, I can't sell that business bottom-up because it's too important. And I say to them, well, what's more important than safety of your workforce? And we're seeing safety culture being sold in a bottom-up way. So my challenge to many, many founders at this really early revenue stage is, how do you innovate around your sales cycle or your sales methodology as well as your actual product? And so that's really, those are two key things that we're looking for in pre-revenue enterprise software. And I know there's a question coming up about Series A, which is far more about metrics and things, but in these pre-revenue stage, very much around how the product actually changes people's work and how will you sell it in an efficient fashion, and then some sort of evidence that you're able to do that.
Perfect. Thank you so much.
Awesome. Thanks, Vinesh. Thanks, Rick. We've got 3 more questions coming from the founders on screen, and then we're going to go to your questions. So I can see there's a bunch that have already been put in Q&A, but please keep those questions coming as well. So next we're going to go to Steve from List Social. Steve, you've got a question for Kylie.
Hi, how you going? Just quickly with List Social, we are disrupting the real estate sales industry by basically offering everyday people the opportunity to introduce buyers and sellers, and basically getting the incentive across to everyday people instead of real estate agents. So that's what List Social is. My question is, obviously with cold introductions, like you were talking about cold and warm, with colder introductions, at what point do you become a hassle if you keep sending, multiple emails and not receiving any answers? So that's, my question.
Yeah, good question. We all, investors tend to ask to be kept informed once we've said no to a company. We normally don't say no, we'll say not yet and ask to go on your investor update list. It's up to you how frequently you send those investor updates. The usual cadence once you've received investment is monthly. But depending on how fast you're growing, it may not actually be in your best interest to send monthly updates. Maybe it's better to send them every 2 months. Maybe quarterly updates is better. So I think you want to keep your potential future investors informed, but you also want to show momentum, right? You want to show that you are still growing, and prior to receiving investment, you've got the ability to judge that, to design that so it works for you. I would also say that, in terms of if someone has said no for your seed round, you should definitely get back in touch with them before you raise capital again. But don't. Again, you need to show sufficient growth between hitting those milestones.
Thank you.
Thank you. And then we've got the question about Series A from Warren to Rick.
Hi there, Rick. So I'm Warren Billington, the CEO of Sift. We are an AI-driven document intelligence company. So my question is more aligned to Series A funding. We have a couple of C rounds under our belts, and we're looking for Series A funding in the next 9 to 12 months. So really keen to understand what are some of the key criteria or metrics that you're looking for that we should be thinking about and aligning our business towards over the next 9 to 12 months. So I guess what differs therefore in terms of the metrics you're looking for from a Series A perspective that is different at a seed level?
Yeah, great question. So look, by the Series A, we're really looking for the beginnings of product market fit. And product market fit is this amorphous thing. I'm sure many people have heard the term, but what it really is kind of this idea that people really like and get value from the product, and that they're willing to buy it at the kind of volume that will sustain the vision of the business, right? And we're not, but at the Series A, expecting there to be full proof of product market fit. What it is the beginnings of proof, where we can look at it and say, yeah, we think this is going to get to, or be at product market fit. And really the Series B, which is the next round, is when you want to be at product market fit, and then you're pouring capital into the business to really grow it. So Series A is about really proving out product market fit. And so there's two parts, I think, to this. One is growth, and that's the speed, obviously, at which you can get new users. And we talked a little bit about revenue. So revenue is a really great metric, but it's not the only metric. And many of our businesses, for example, Safety Culture, didn't have revenue when we first invested, but we could really see this great usage. And what we're really looking for with growth, if we want to turn it into revenue, is this ability to sort of hit about $1 million of ARR and then triple, double. I'm sure you've heard that before, but that takes you to about 100 mil of revenue in about 5 years. That's the holy grail, gold standard. Hardly any business actually manages to do it, but we want to do it. We want to be convinced you have a chance of doing that. So growth is this first idea, and we're really looking for accelerating growth. So it's not just, it's that each month is better than the last at this early stage. The second type of metrics we're looking for is engagement, or really value that the user gets. And what we're trying to find here is proof, early proof, that you have a core set of really happy customers and that they use it frequently and get real value out of it. And so what sorts of metrics are these? These are things like, so for Canva is a good example. In the early days, we picked a metric which was percentage of designs that are actually published, so downloaded or used on a social media platform, because we thought that unless you published the design, it wasn't actually useful to you. And we were really happy to see Canva getting 85% publish rates on their designs, which meant that people were actually using those designs. Churn is obviously important, so the idea that people keep using it, so repeat usage, cohort analysis, all really important as well. So they're the two key types of metrics, growth and engagement. And then I guess the next idea is this idea of optimizing for sales. So that's things like cost of acquisition. So we're not really so focused on that metric. That's really a Series B metric to really focus on, but it is good to see it and know it and understand what you think is going to happen to that metric. Either it's really awesome right now and you think it can stay the same, or it's not so good right now, but you think it's going to come way down for a particular reason. And then I just add the last thing is on the team side. So again, for the Series A, we're looking for proof that you can actually build a team and that you've started to build out the culture in this team and can continue to build it. So those are the key things that we look at Series A.
Cool. Thanks, Warren. Thanks, Rick. Last question is coming from Catherine from Brillup. Catherine, you've got a question to put to both Rick and Kylie, and then we're going to go to questions from the audience.
Thanks, Rebecca. Hi, my name's Catherine Raphael, and I'm the founder of Brillup, where we're developing tools to help people find and create independent courses. So my question to both Kylie and Rick is it worth chatting to VCs if raising capital isn't your goal right now?
I think that it's a tough question to answer because there is nothing more valuable than your time. So if you don't think venture investment is ever going to be a good match for you, then you're unlikely to get great advice and form a great connection with an investor just from a single meeting. If you think it's more than likely on your roadmap, then starting to invest in those relationships early will make your decision, your investment process when you make the decision to raise a lot more streamlined. We love to invest in founders who we've known for a longer period of time. It makes it much easier for us to get to yes because we've got a relationship already. It's very hard to just say yes to someone off a deck. So if it's a good use of your time, absolutely do it. But it's not your job to keep us as investors, full of all the knowledge that we want to have about your sector. And investors, we're curious people. We love asking questions, and we can inadvertently and sometimes with the best of intentions take up your time just with trying to learn and understand the problem that you're working on. That may not be in the best interests of your company right now.
Thanks, Kylie.
Thanks, Kylie. Rick, do you have anything? When should founders start to approach you? Do you want people to approach you before they're looking for investment and build a relationship?
Yeah, look, I agree fully with Kylie. It's really up to you. We are very happy to talk to people who are not yet ready for investment, and we can give you a pretty quick read of whether it's in our sweet spot, something that we would invest in, and that can kind of, I guess, guide you a little bit on whether you want to, spend a lot of time and effort in sort of keeping us and others up to date, or whether, you focus on other people or other ways to get capital.
Great.
Awesome. Thanks, Catherine. And thanks to all of the other founders who came online to ask questions today. They were really good questions, and I know that I learned a lot through watching it. I want to go to questions from the audience. So we've got 10 minutes left. I'll start with a question from Natalie, who's asked if this webinar is just dedicated to tech startups. I know that there are a lot of businesses, retail businesses, agency businesses, other types of businesses that aren't tech businesses that might also be thinking about raising capital. If you guys do or don't invest in those types of businesses, you can let us know. And if you have any advice of what those types of businesses should be doing, what kind of investors they could be reaching out to. I'm going to start, Rick.
Yeah, so obviously we focus on tech, really high growth investments, and that's kind of our mandate and what we do. I'm not an expert on all the sources of capital out there, except to say that in Australia and obviously Sydney in particular, there are a lot of angel investors around now, and the angel community is growing up very nicely. And you'll find that people in these communities are very willing to invest as well, and don't need to see quite the extreme growth that we're looking for in the venture capital context.
Thanks. Is there anything you'd like to add, Kylie?
No, we're much the same. We are exclusively tech at Eleanor, but we have plenty of angel investors who invest with us, who are open to investments that have perhaps a less aggressive growth trajectory, but are de-risked in some way. So venture and the type of tech investments that Blackbird and Eleanor make, they tend to be, boom or bust. There's plenty of grey in between, but we are really looking for those ones that outperform. Whereas some of these other, agency retail investments, they're not as binary, and that can be really attractive to the right kind of investor. And we can, sometimes connect with people in our network who are interested in that type of risk profile.
Awesome. Thanks, Kylie. I know Sydney Angels as a group, which Rick mentioned, do invest in a lot of non-tech based businesses, and we will share a link to Sydney Angels in the chat if you'd like to check them out. I'm going to go through other questions. Another one by Natalie. Are you bound by non-disclosure agreements? I know a lot of founders are worried when they go to see investors that their idea is going to get out there and it's going to be given to another business. If you can just share your thoughts on non-disclosure agreements and that concern. Kylie, do you want to start with that one?
Sure, happy to. We don't sign non-disclosure agreements in the first instance. It's too much risk for us to assume as an investor to have 15 NDAs a week floating around. There's just no way that we could put ourselves on that amount of legal risk. Our insurers would not be happy with us. We always, investing relies, on goodwill. We are professionals. We are not about to breach obligations of confidentiality that we assume in the ordinary course. We don't need to sign an NDA to prove it. If that makes people uncomfortable, we always invite them to just take out anything that's highly sensitive from your deck or from your data room in the first pass. We have had instances where we've signed a non-disclosure agreement towards the end of an investment process for founders that were particularly sensitive around sharing details of their source code for doing the tech DD or around their customer pipeline. They wanted to keep the actual names and indicative quantum out until the very last stage. That's fine. If it's very specific things, we'll sign an NDA for that right at the the end, kind of almost as a checkbox. But an NDA upfront is just not commonly done and not something investors can easily agree to.
Thanks, Kylie. Anything to add, Rick, on would you sign an NDA?
I just agree with that. We have a policy of not signing NDAs, but it's all about trust, and our reputation is everything. And so we're very careful with confidentiality. And I think founders should share as much as they think they feel comfortable sharing. And I do also think that the worry, this is all about execution and about how well you can execute your idea and continue to iterate and evolve the idea. And it is really important that people respect those ideas and take them really seriously, which we do. But a lot of the success is around the execution. And you will, to be successful, have to be shouting your idea from the treetops to anyone who'll listen to you very soon. So we want to see founders that come in with the confidence of being willing to share their ideas. The only time we would sign an NDA would be if there is patent applications in progress, and sometimes that is important to allow the patent to continue going through.
Sure. Question from Leon. I'll give this one to Rick. So do you use safe notes or convertible notes at an early stage? If you can just briefly explain what a safe note is. Yes,
we quite often use safe notes and convertible notes. In fact, more often safe notes now. So safe note is an instrument where the investor invests money into the company, and that does not that money is not used to buy shares. It's actually it's a note as such. So it sits and gets repaid first. It's not actually debt. It's convertible debt. And when you do your next funding round, that debt converts into equity, into shares at a predetermined price. And normally that predetermined price is based on a cap, so a maximum value, and a discount to the round. So it might be a $10 million cap and a 20% discount to the next round. So we quite often use them. They're particularly their benefits are that we're not becoming a shareholder, so you don't need to negotiate a shareholders agreement. So you can usually get them done more quickly and more efficiently. The disadvantages of them are that your price is set in the future and you don't know what the price will be. And although the people tend to think that they'll get a higher valuation than the cap they put on, if they in fact do get a lower valuation, you actually end up getting more diluted and worse off in many cases with a convertible note than you do by just pricing around, say, at that cap and selling equity as you would in a standard round. So definitely pros and cons, but a lot simpler and quicker to get a safe note done.
Cool, thank you. I'm going to ask just two more questions. One's from Murat. So what's your definition of a successful investment in terms of ROI timeframes and any other aspects? Kylie, what do you see? What do you hope for? And what would you say in your portfolio has been as successful?
Yeah, sure. I mean, because we're not a fund as such, we have a vintage fund, but we structure our investments to be deal by deal. So we don't have the fund metrics that the more structured funds have. We don't have a 10-year, we haven't written an investment plan with a 10-year thesis that we're locked into. So we have a lot more flexibility around what constitutes a good deal and a successful deal than most, which is great. That being said, we always go into it looking for something that has the potential to 1000x. We are looking for that explosive global growth. That's not every investment will 1000x, of course, but just we like to see that it's a possibility to make it worth the risk of writing the very speculative first stage check, because we assume that 50% of our investments will fail. That's just the realities of being the first check in. Building businesses is tough. So to justify that risk, we need to see outsized returns in the winners. However,
Thanks,
yeah, Oh no, I was just going to say that the second part of that question was an example from the portfolio, which is not a 1000x return because we're not there yet. But we had a portfolio company, Fresh Equities, did their Series A recently, and even though it was only Series A, they offered their seed shareholders, including us, the possibility of secondaries, which is where the early investors sell back their shares at the higher valuation, kind of getting that cash out exit, which was more than 3 times what we'd invested in about a 12-month turnaround period. That's extraordinary for secondary to be offered at a Series A, and we were really thrilled by being able to offer that to our investors. No one took it up. Everyone wanted to double down and let it ride, because we're greedy. Long-term greedy, as some of our investing buddies say, and we want to see those outsized returns, and we're very happy to wait for them.
Thanks, Kylie. There's just another question that's come up that I think is a really great one I'm going to put to Rick. Can you share any examples of when an investment hasn't worked out? Kind of a theme as to what is the case and what lessons could be learned, or maybe if you could just share us a story of what happened, not necessarily.
Yeah.
Giving us a specific example, but
yeah, sure.
Yeah, but these things don't always work out, and I think people like to know what happens when things don't work out.
Yeah, absolutely. So our whole investment strategy is built around a high tolerance for failure. We know in any fund that we raise, we'll invest in 20 to 25 companies. We're hoping for 1 or 2 to do spectacularly well. We're hoping for 4 or 5 to do really well. And the rest will either make our money back or we'll lose often all our money. And that high risk tolerance, I think, is really important for founders to understand. If you try your hardest, do it in the right way and fail in the right way after acting transparently, doing what you set out to do, and doing it honestly, that is not a problem if we lose all our money. Obviously, we will fight as hard as we can to help you make the business successful, and we will fight for every dollar for our investors. But if things go wrong and we have to shut down the business, that's life. And I think one of our roles as investors, as good investors, has to be to understand when that point has come and to work with the founder to either shut down or try and sell the business and hopefully recoup some of our capital, and to really help take some of the stress out of the situation when things have got to the stage where they're not going to obviously succeed. So that has happened already to us a number of occasions, and I think the most public one is a company called Shoes of Prey, which is a company that I know and love and spent a lot of time helping out. And I know Rebekah knows the founders really well. And that business ended up not quite working. They had a really good shot at it. They raised capital from the US. They built a large revenue stream. And unfortunately, it just didn't quite work out in the end. But the great thing about that is after shutting down that business, we've just backed one of the co-founders again in their next business. And that is based around this great relationship that we built even through a business that failed.
Awesome. Thanks, Rick. I'm going to sneak in one final question, which I'll put to you again, Rick, if that's okay. And Kylie, please jump in if you've got something you'd like to add to this. But what's changed since COVID? So both in terms of how people should approach you, and also, is there anything that's changed in terms of the types of companies that you're looking for?
Yeah, so in terms of approaching us, hasn't really changed much at all in terms of ways to get in touch. And I think all about that. We are doing a lot of things by Zoom. So we have made investments where we, particularly during the middle of COVID lockdowns, where we hadn't met the founder in person, we'd spent a lot of time on Zoom. I think we do tend now, I think we would be trying hard to meet founders. In terms of types of business, hasn't really changed for us. Really still just looking for big global businesses that are tackling a big and interesting problem. Obviously, there are new problems that have popped up, in a post-COVID world, but for us, it's very much business as usual.
Thanks, Rick. Is there anything you'd like to add, Kylie?
No, except that the way that we've been thinking about COVID in terms of the types of investment opportunities that we've seen, it's more about accelerated inevitabilities, these kind of themes that we always knew were coming, you know, things like telehealth and remote education, you know, turbocharging working from home. These things were all on, you know, they were all kind of slowly plodding along, but COVID has amplified them and made their kind of their path a lot quicker. So, you know, we're certainly seeing lots of companies in those accelerated inevitability buckets.
Awesome. Thank you, Kylie, and thank you, Rick, and thank you to all the founders who came on and asked their questions today as well. Thank you also everyone for participating. A couple of things I wanted to share. Next week, we have a special event with Steve Vamos, who is the current CEO, global CEO of Xero, on leadership in 2021. There'll be lots of opportunities to ask Steve questions. I'm sure that one will fill because we are limited by the Zoom capacity. So please do register if you'd like to attend that event. So it's with Steve Vamos, the global CEO of Xero. And the following week, we have Craig Davis, who's one of the co-founders of Sendle, who runs the Google's Search Inside Yourself program. So he's going to be giving us some of that program on emotional intelligence and resilience in leadership in times of uncertainty. So that will be a great one as well. We are sharing the links to both of those events in the chat now. Thank you very much to the City of Sydney for hosting these events. We'll be back next week at the same time. Hope to see you there. Thanks again to Rick and Kylie, and I hope you got a lot of value out of today. I'm Rebekah Campbell from Zambesi, and we'll see you next week.